Could the next shock come from AI wiping out white-collar jobs, geopolitics fracturing global trust, or nations quietly moving away from the dollar? Are you ready for a world where the old investing rules, financial safety nets, and even daily work no longer apply? Luke Gromen says most people are not. He sees capital rotating aggressively into gold, Bitcoin behaving more like leverage tech than digital gold, and a system that now rewards flexibility and optionality over blind conviction. He argues that the real danger isn't volatility itself, but the hidden fragilities in markets, currencies, and debt that only reveal themselves when timing breaks down. From Trump's Greenland threats to subtle shifts in global power, if he is right, the transition ahead will be brutal. Hello everyone, and welcome back to another podcast summary video. In this one, we break down Luke Gromen's recent appearance on Coin Stories. The conversation starts with Bitcoin, but it does not stay there. It quickly expands into the forces driving today's markets, from global capital rotation and geopolitical strain to AI disruption and the growing instability of the financial assumptions most people still rely on. This episode runs well over an hour, but we've distilled the most important ideas into a clear, structured breakdown, so you can focus on what actually matters without having to listen to the entire conversation. If you find these summaries useful, please like the video, subscribe to the channel, and share your thoughts in the comments. It genuinely helps support the channel and keeps this content coming your way. Now sit back, relax, and let's walk through the forces Luke believes are already reshaping markets and the global economy. Luke Gromen begins by pointing out something most investors miss because they're too focused on price charts instead of flows, which is that capital is already moving, and is doing so in a very familiar historical pattern. According to Luke, we are watching a rotation into gold that closely mirrors what happened in 1930, again in 1972, and again in 2002, moments when confidence in the broader system quietly cracked long before the majority noticed. Using data from North Star charts, Luke highlights that 12 separate market indicators are now flashing a bear market in most assets when measured against gold, including equities, bonds, and even parts of the credit market. That matters because when everything starts losing value relative to gold at the same time, it usually signals that investors are no longer chasing returns, but repositioning defensively in anticipation of instability. And the uncomfortable question Luke keeps coming back to is this: if capital is already shifting into protection mode, why are so many people still behaving as if the old playbook is intact? Luke Gromen is very direct on this point, and it is where some people begin to feel uneasy. He believes Bitcoin will eventually function as a neutral reserve asset, but he also stresses that today, it simply does not trade that way yet. In this stage of the cycle, Luke explains that Bitcoin behaves much more like a high-beta technology stock, meaning it amplifies both upside and downside, depending on liquidity conditions rather than acting as a stable hedge. This is why, during the current rotation into gold, Bitcoin has effectively entered a bear market when priced in gold terms. Luke emphasizes that this is not a failure of Bitcoin itself, but a reflection of how institutions still classify and treat it. In environments where trust is fragile and capital becomes defensive, institutions default to what they already understand, which raises a key question Luke wants investors to sit with. If Bitcoin is still treated as risk-on by the largest pools of capital, how should individuals position without confusing long-term belief with short-term exposure? According to Luke Gromen, the real story underneath all of this is not Bitcoin versus gold, but trust versus uncertainty, and how systems behave when confidence erodes. He uses a striking historical example to make the point clear, explaining that decades ago the United States literally flew a plane full of gold bullion every month to Saudi Arabia to settle oil imbalances. It was slow, costly, and inefficient, but it worked because the settlement was undeniable and trusted by all parties involved. Luke frames this as a real-world version of proof of work, where energy, time, and expense were the verification mechanism. Fast forward to today, and trust between major powers like the US, Europe, Russia, and China is visibly deteriorating. In that environment, Luke argues that nations are unlikely to experiment aggressively, instead clinging to assets with long histories of settlement and verification. And that leads to a question that sits uncomfortably beneath the surface. In a world where trust is shrinking, which assets do you think governments will rely on first, and which ones will be forced to wait? Luke Gromen then shares a personal decision that perfectly reflects the framework he has been outlining. He explains that he sold a significant portion of his Bitcoin holdings when one Bitcoin was worth roughly 23 to 24 ounces of gold, using the proceeds to pay off a lake house mortgage. From a purely financial perspective, the decision made little sense, given that the loan was a 30-year fixed jumbo mortgage at around 2.96%, which many would consider effectively free money. But Luke was not optimizing for yield or theoretical return. He was optimizing for optionality. By eliminating debt, he removed future constraints and increased his ability to respond to uncertainty. He still maintains Bitcoin exposure through direct holdings and private equity investments, but the sale gave him flexibility to act if conditions change, potentially 3 to 4 years down the line. The broader lesson Luke offers is that in unstable systems, the ability to move freely often matters more than extracting the last bit of upside. Luke Gromen then turns to technical signals, and this is where the tone becomes noticeably more cautious. He points to long-term indicators that have historically shown a 100% batting average for signaling 60 to 70% drawdowns in Bitcoin, while being careful to say this is not his base case. Still, Luke refuses to dismiss the signal outright, especially given the surrounding conditions. He outlines several risks that could trigger forced selling, including leveraged buyers needing liquidity, institutional hesitation, a potential shift toward U.S. economic isolation, or broader macro shocks such as recessions or trade disruptions. The key insight Luke emphasizes here is not about predicting price, but about respecting fragility. Chasing moves in unstable environments, he explains, is how people lose optionality, while waiting for confirmation, even at the cost of missing early upside, is often how capital survives long enough to matter. According to Luke Gromen, one of the most underestimated risks right now has nothing to do with Bitcoin at all, but with how quickly artificial intelligence is moving into the labor market. He believes AI will disproportionately impact marginal high-paying white-collar jobs, particularly roles earning over $80,000 per year, such as mortgage brokers, commercial lenders, and medical claims processors. These are jobs built around rules, paperwork, and decision trees, which AI can already perform faster, cheaper, and often more consistently. The real danger, Luke explains, is not just job loss, but wage compression colliding with a debt-heavy system, where people still carry mortgages, car loans, and student debt that assume income stability. He draws a historical parallel to illustrate how fast this can happen, reminding listeners that after China joined the WTO, U.S. manufacturing employment fell 35% in just 7 years, catching society completely off guard. Luke Gromen then zooms out to examine the cultural consequences of these shifts, arguing that the economy has become increasingly financial and performative rather than productive. Too many people are trained for financial engineering, content creation, or speculative niches, while too few are focused on building or maintaining real-world systems. He points to examples like students at USC aspiring to become YouTubers, now competing not only with other creators, but with AI-generated personalities that never age, sleep, or burn out. At the same time, gambling apps, subscription platforms, and automated financial tools quietly replace traditional roles while increasing dependency on centralized systems. Luke warns that this dynamic creates a brittle society, one that relies heavily on government backstops and financial infrastructure that itself is becoming less stable. Luke Gromen closes the loop by returning to the idea that ties everything together: optionality. He argues that the years ahead are likely to move fast, break assumptions, and punish rigidity, especially for those locked into leverage or outdated frameworks. Debt reduces flexibility, while overconfidence destroys timing, and blind faith in old models creates exposure people do not recognize until conditions change abruptly. Luke is not predicting collapse, but he is clear that humility matters more than conviction in this environment. The investors who survive will not be the ones who guess right every time, but the ones who stay liquid, remain flexible, and are willing to accept small losses in order to avoid catastrophic ones. And it all comes back to a simple reality Luke keeps emphasizing. In a world where systems are shifting, optionality may be the most valuable asset you can hold.